Also back with us, Jeremy Siegel, professor of finance at the University of Pennsylvania's Wharton School. He called the market bottom back in March 2009 and says stocks are now a good buy given the strength in the economy and outlook for earnings. So, Jeremy, let's kick things off with you. And I got to ask you, I'm not sure, I know you and I talked earlier this morning, you know, the ratings agencies and Buffett's appearance and testimony before the commission was a big deal. Not sure if you caught much of it. What do you think about the ratings agencies and the role that they need to have going forward?
Yeah, I caught headlines as they scrolled down on Bloomberg. I didn't catch it live. I mean, those ratings, obviously, for those mortgage-backed securities were appalling. I heard one official said we're very disappointed in the performance. I mean, that must be the understatement of the year when something that's rated AAA goes down to 0. To say I'm disappointed. It was appalling. They were absolutely unprepared. They did not know how to rate the securities in the housing industry. And that was one of the major problems because so many of the banks and ultimate buyers relied exactly on those ratings. And, you know, we put them up on a pedestal as if Standard & Poor's and Moody's are, you know, the greatest to be listened to. But clearly, you know, they muffed the ball terribly in the last crisis.
Jeremy, to be fair, you know, and as Warren Buffett said, nobody expected a drop, and Moody's said nobody clearly expected a drop of this magnitude. I mean, you could say they should have at least expected the possibility that housing prices turned down, but really nobody could have expected such a huge drop, right? I mean, they couldn't have known to rate those things absolute junk.
Well, I agree on that, but from what I understand, they didn't even factor in the possibility of a decline. And this is after housing prices have gone up 100%. To say, well, they've never declined in the past is one thing, and then when they go up in 3 or 4 years, 100%, to say there's no probability that they're going to decline over the next few years, that seems to me a big estimation. And again, AAA means under all circumstances this security is going to pay, but there's only 4 U.S. corporations plus the U.S. Treasury that get that ranking. You know, clearly, I think that one could have said that was wrong in 2006. It was really 2005 is when the market really peaked. In 2006, it was already beginning to top off.
Right.
They should have had warnings.
Hey, let's switch gears.
Definitely should have had warnings.
Jeremy, let's switch gears because got to talk about the rally underway today. Definitely a different tone from what we got yesterday. What do you think? I mean, could we start to maybe build some more upside here, an upward trend, if you will?
Well, I think this is what's happening. I mean, after the euro crisis, which, you know, isn't over, but the fear that that's going to infect all the debt, just like the subprime crisis did two years ago. We all thought, hey, we might be entering a soft patch with the data. That was the worry of many of the forecasters that I look at. Well, the last couple of days of data have been very strong. Now, of course, we get the mother of all data on Friday with the employment report, and that'll tell us a more definitive story. But at least as the data we're getting in right now, it is continuing the recovery that we had in the first quarter, and we're really not seeing any significant slowdown. So people are saying, hey, you know, with earnings estimates for this year, 2010, going up to $82 a share. Next year, above 90. You know, if I can buy at 1086, the S&P 500, wow, there's not many points in history where you can buy so cheap.
Well, Jeremy, what do you think about the energy names? There's obviously been a lot of reaction as a result of what's going on with BP and the spill in the Gulf there. But what about the energy names going forward?
Well, yeah, I mean, I think there's some great yields also going on in the energy sector. I know, you know, stop paying a dividend with BP. I guess BP is almost 9–10% yield. But if you hold reserves outside of the Gulf, hey, you may benefit because if there's less oil it's going to be drilled, that's got to be good for oil prices, and that's good for the valuation of reserves. So some of those oil-producing companies outside the Gulf really could net gain from this, and they are sold off, and they are looking very attractive from either an earnings or a yield dividend basis.
Jeremy, you agree, not an overly bullish signal because of the volume factor.
Yeah.
And we all, it gets a little technical, but we do keep an eye on volume to kind of give you an idea of the conviction behind a trade.
No, even though I'm a fundamentalist, I do look at these technical factors. And yes, you always prefer a rally on high volume to low volume. But we should also understand, I mean, we had a pretty quick, strong market break. And there's always a backing and filling process, up and down, volatility, forming a bottom, and I think that's what's happening now. And if we don't have the world fall apart, which is almost what some stock prices were predicting, I think this is the base from which we're going to see a very, very good rally towards the end of this month and into the summer.
Now, Professor Siegel, it's Dominic Chu here. A quick question for you now. I talked to a couple traders today who said maybe the lack of volume because nobody wants to get in front of that jobless numbers, that non-farm payrolls number coming out on Friday. Estimates are for 500,000 jobs created. Some estimates as high as 900,000. I mean, is this going to be temporary? Is this going to be census hiring? I mean, what's going to happen there?
Well, boy, they're getting nervous really early. We're not even Thursday. That's usually when people get a little bit cautious. Yeah, it is a big number. It's always the biggest number of the month, and I think some standing back. But I really just think it's the ebb and flow of volume, as you spoke of earlier, that we're really seeing in here. And I think we need a good jobs report on Friday to really send this off the bottom that we've seen.
Jeremy, I want to ask you a question. A viewer wrote in and said that after hearing about our conversation with auto sales earlier, he can't think of an industry that better exemplifies our economy's dependence on the Fed's zero interest rate policy. And because of that, he's curious to hear your take on what you're looking for to signal that the economy is strong enough to actually weather higher interest rates. I mean, I know you're bullish and I know you're confident about this economy, but keep in mind we've still obviously got it easy as far as monetary policy, right?
No, and that's a good question. I thought that the Fed would start raising interest rates by the fall because I thought the economy would be strong enough, and I thought inflation would begin to move up. With this euro crisis, though, I think all Fed tightening has been put on hold, and now I can see the Fed holding all the way to the end of the year and into 2011. So I think we're going to have very, very good accommodative monetary conditions over the next 3 to 6 months for the auto industry, for the housing industry, and basically for the economy.
And everybody, I just wanted to draw your attention to a story I just noticed here that BlackRock's Larry Fink coming out and saying that things are looking good in terms of stocks. He apparently spoke today in a meeting at the Oregon Investment Council, and he talked specifically, and a lot of people have been doing this, about second quarter profits. He thinks that they're going to be stronger than what analysts are expecting. And indeed, we've had a lot of investors say profits are what really are going to be the driver going forward once we get over these concerns about Europe and what's going on in the Gulf. So, Jeremy, let me ask you, what's your expectation? I mean, others, naysayers, have said profit estimates in some cases are getting too high. So what's your view?
Well, first of all, you're absolutely right. The two major factors that influence stock prices are interest rates and earnings. We just talked about interest rates. They're very likely to stay low for quite a while. The long bond at, 330 today couldn't be more favorable for stocks. And earnings, these last 2 quarters have beat earnings estimates almost by record amounts. The revisions of forecasters' estimates for S&P 2010 and 2011 earnings have been about the greatest I've seen. That's the backstop that I think will make for a bull market later this year. Interest rates and earnings.
I wonder, you've said in the past you thought the Fed was behind the curve here, Jeremy. Do you still think so?
Yeah. Well, they stayed back and maybe far enough back to catch the ball now. Given what's happened in Europe, the strengthening of the dollar, oil coming down from 85 down below 70, now a little above 70, commodity prices sinking, I say it's certainly a hold situation now for the Fed. We need those commodity prices to go back up and much more inflation for us to raise from this position.
All right, Jeremy, thanks so much for joining us. Jeremy Siegel there from Wharton, Judd.